This is someone who first became quite well known as a co-founder of PayPal, which was really the original fintech company. And he was a co-founder along with Elon Musk and Peter Thiel. And he has since, what he has done now since 2012, he has started a company that's really focusing on trying to revolutionize the point of sale financing space, something that has, I think, no real major player has really dominated that space yet. And he is here today with Alex Rampell from Andreessen Horowitz. So please join me in welcoming Max Levchin, CEO of Affirm, and Alex Rampell. Gentlemen.
All right. Well, since we're talking about the future of credit, which is a big topic, I figured we'd start off with a form of credit that almost everybody has, which is a credit card. And perhaps we can deconstruct a credit card into the form factor, which is, it used to be plastic for a long time, now it can go in your mobile wallet. But there's also the back-end meaning of an unsecured revolving credit line. And normally it's two sizes fits all. There's the cash advance, and then there's everything else that you buy on your credit card. So where does the future of this credit instrument go, kind of front end and back end?
So I think one of the most misunderstood things about credit cards is that everybody wants to kill the front end. And the front end is actually almost perfect. There was 20-ish years ago when I was in college, there was an attempt to make this thing that you would wave in front of a gas station and it would charge your credit account and you could immediately start fueling. It seemed like a really good idea and I tried to get my hands on one. And just before I could actually get one in the mail from MasterCard, it was canceled because it had no pickup. The stick your card in, pull it out, type in something and go is actually a pretty awesome user interface. And I think what's going to happen is we're going to just shift out of physical form factor into a wallet form factor that's on your phone. Basically, software is going to eat the card, but between now and then, we're probably pretty safe there. The back end, which is kind of fun to beat up on because that's kind of part of the industry that I'm in, is actually also okay, in part because it's the underlying financial instrument that's been exposed directly to the consumer, which is kind of amazingly stupid if you think of it. It's a little bit like giving you this beautiful piece of software and has every feature in the world and asking you to configure it using assembly language, which is a reference for nerds. But the notion of a credit card being a good financial product is flawed because there actually isn't a financial product. There's an instrument underneath that is, old singing, old dancing line of credit, which is unbelievably flexible. It's kind of the most powerful of all power tools, which also has the obvious consequence of the most likely to accidentally be part of sewing off your own leg. And so the thing that's missing is the middle tier, something that actually helps you make sensible financial decisions. So my thoughts for the future of credit cards is maybe we'll finally get around to building real software that helps consumers make purchasing decisions, make thoughtful financial decisions, that is a real piece of software as opposed to this really complex financial product deep underneath called the line of credit, which incidentally most people don't understand, even people in the industry, or this really nice mag-stripey interface which should be replaced by a tap or some other form. But that's almost a superficial question.
So do you think that lending or more sophisticated lending and financial products will help uptake for mobile wallets? Because if you look at the data right now, I think Apple Pay is probably under 2% of all of retail spend across the US. So will kind of more sophisticated lending and financial products help improve that number?
Yes, but I think the wallets themselves are kind of a first prototype of what really happens. Wallets came in and said, let's abstract the card as it exists today, the stripe, the void, and the really sophisticated financial product underneath, financial instrument underneath, slam it into a picture, put it on the screen, and make the last mile user interface touch really, really cool. And of course, it is cool, and that's why Apple Pay is growing. That's why all the various forms of Apple Pay-like products are growing. But slowly, because it hasn't really changed anything. I think that the door that opened is the ability to innovate on software. So I'm not really sure how it's going to work practically, but the wallet itself is a platform for interesting financial systems to be built that consumer can interact with. The ideal user experience isn't I pick my card and then I tap. It's not that different from I pick my card from my wallet and I swipe or I stab or whatever. The interesting user experience is I walk through, my wallet buzzes, and the, forgive me, AI in my phone says, hey, that purchase you made, that should be financed in a simple installment loan. And I do nothing because that is the smart decision, and my financial software actually already helped me out. So I think that's where it goes, and I think wallets kind of create that bridge. In and of themselves, they're not necessarily going to build it.
That makes sense. So on that topic, there's now $1 trillion of consumer credit card debt. Does the idea of credit card debt, do we still call it credit card debt in 10 years, 20 years, 30 years? Does that go away? Because in many respects, I mean, like when you get a debt consolidation offer from many of the people in this room that goes to your home address, it says refinance your credit card debt. You can imagine all $1 trillion of that being refinanced away into a different form of unsecured or even secured consumer debt. So how does that change?
So 10 years from now, we certainly are going to call it credit card debt, because 10 years from now, one of the things that's most entrenched in the world is, in our world, is the Verifone box at your local retailer. So no matter what, you're going to be touching, swiping, stabbing a point of sale system, and that's going to harken back to the card days, and we're going to call it credit card. It's a lot easier to prognosticate 30 years out than 10 years out. So 30 years out, I suspect credit card debt will be kind of an old school term. Fundamentally, credit cards, I enjoy ragging on them in many ways because they're just so easy to pick on, is this amazingly flexible and therefore incredibly hard to configure and consider for consumers device. It's like literally, sort of back to my power tool analogy, the power tool really only makes sense for a professional to use or for somebody who can be such an enthusiast they'll read the manual. And the manual for a credit card is in 6-point font on the back of the statement, which no one ever reads. So that's how we wind up with $1 trillion in debt. And then there's a whole industry that trails that off and says, well, we'll refinance it for you, don't you worry. We'll give you another blunt tool to refinance this giant lump of credit that you have. You'll pay a little bit less and we'll transfer the loan and we'll do it all over again in 12 months. And I think ultimately what happens to, and this will happen very slowly because financial instruments are things in motion, they live a long time, and these days you can get yourself a 8 years, 0%, don't look at the fine print, deferred interest offer card that will probably screw you when you least expect it. These things go a long, long, long time. The consolidation industry only prolongs it. But what I think will ultimately happen is the software that will come into the picture and is already coming into the picture very quickly. You will start seeing a more sophisticated choices being made by consumers as they charge. And as these things take place, transactions will go into buckets that are appropriate for them. There's absolutely nothing wrong with paying interest so long as you know the amortization schedule, so long as you know when you will stop paying interest, when you will stop being in debt. The reason reading the manual to the power tool is so important, revolving line of credit allows you to never be out of debt literally. So long as you make the minimum payment, it's a very, very, very long time, and if you increase your balance, it might be forever that you'll stay in debt. Once software takes over, it'll be a lot easier not to be in debt, and therefore the need for the $1 trillion refinanceable debt industry will start sunsetting. But I anticipate it'll be less of a thing 30 years from now. It probably won't be a zero thing for quite some time.
Got it. Then, one thing about that, so there are a lot of industries. I think autos is one of the most pronounced, but homes as well. Like, what would home sales be without the 30-year mortgage? And likewise, I mean, a lot of people don't realize this, but auto leases are about 30% of all autos that are produced. They end up in a lease. So these are the things that lubricate demand for those two sectors. I mean, what can be learned? Because it's just, credit is so intertwined with the production and the sales mechanism for those two industries. What can be learned from that for other industries? Because you kind of have credit cards that kind of do their own thing, and then you have all sorts of other industries that end up benefiting from them, but not as much as they could if they were more enjoined.
Yeah, it's actually, so it's a great sort of a example of it doesn't have to be this way. So if you're buying a house, which is a long, complicated, in many cases, government-involved affair, there's no real pressure to sort of close the transaction very quickly. You can take your time, not just getting underwritten and doing your diligence, but also figuring out the exact financial instrument that will make sense. And I would still argue that mortgage loans are you don't have to look too many more than 10 years back to sort of see how everything can go terribly wrong. But at least the consumer generally, unless and until they're sort of pushed into these ridiculous products like interest-only mortgages, ends up kind of knowing what they're doing. A car loan is a faster, simpler affair where you end up having a conversation. You're sort of kind of being railroaded by the dealer into a loan you probably do not want. But the thing that's fascinating about the car loan and car lease by extension is the fact that it's a fully vertically integrated financial product. From the point of advertising that you saw on TV that tells you there's a 0% loan, manufacturer sponsored, all the way down to the actual purchase that you're making, the pricing, the points, the payment schedule, everything is created not just by some randomly selected issuing bank that doesn't really understand what you're going to buy and you. It's fundamentally an interaction between a buyer and a seller and a whole bunch of systems that stand behind the seller all the way up to the manufacturer and the manufacturer's captive lender and finance arm, et cetera, et cetera. And so there you can see a product that is created to generally make the most efficient value transfer from the seller to the buyer and from the buyer to the seller. That is doable and has been done for a long time, mostly because there's no time pressure. If you go into a grocery store, there's a person behind you in line and they really want to get going. One of the most annoying things as a finance innovator, I like to try new things. So I go into Whole Foods and bust out my Apple Pay and attempt to sort of make it all work. And there's someone with a screaming baby right behind me with a big card that says, come on, can you use a credit card? And so they're like, all right, well, maybe it'll happen eventually. This is what happens, and that's why the card as the end-all be-all, don't think about it, just swipe it, move on, is actually such a powerful instrument. It greases the wheels of regular commerce where the average order value is small enough where you can just pack it into a bucket and revolve away. But it's also why people pay so much in credit card interest, because it's too easy to put it into a bucket and revolve away. And so I think what this sort of a software eating credit cards, to borrow a line from one of your partners, is going to create is the opportunity for either fully automated software or software with some consumer interaction before or after, which before is obviously a lot of what Affirm does today, to create incremental efficiency between the buyer and the seller. As the seller has the opportunity to invest in a transaction by either buying down the interest or offering a 0% interest or introduce more transparency into a payment schedule, whatever it is that will help the transaction take place, can only be done through some kind of interaction or some sort of a post-transaction interaction. And I think what's happening with the overall industry as we go from large price, high ticket items to lower ticket items, we're creating more and more configurability, but also substituting it, some of the human interaction with what will eventually be called payments AI, although it pains me to throw around such a buzzword.
Well, and one of the problems is that whenever you make a transaction, like at Whole Foods, there are actually 5 parties involved. There's you, there's your issuing bank, there's the card network, there's the acquirer of the merchant, and then there's the merchant. And then actually there are even more parties if you count the TSYSs, the FISs, like all the guys that run the back-end software. So does that stack collapse to a smaller number of parties that help officiate the exchange of value?
You've forgotten for at least half these cards, there is a marquee sponsor on the card itself. So there's a logo. One of the other favorite punching bags of our industry is the magical musical chairs of rewards, where I show up to a small merchant to buy lunch. The merchant pays 2.5%, which is marketed to the merchant as a fraud insurance, but of course 95% of that is immediately yanked from both parties, handed to an airline or a hotel chain, and then I get back through the benevolence of the card issuer in a form of points that I'm not expected to spend anytime soon. So that's another set of systems. There's a loyalty management program in there. There's some really sophisticated software that figures out.
At least 5, right? Yeah.
At least 5.
Yeah.
At least 5. The complexity of the industry is a thing to behold. So I don't know if it collapses because this is actually very, very complex software. Part of the reason why the chart of time to innovation quality for payment industry probably looks something like this, where as we went from kind of a cash and check to cards, there was an incredible pace of innovation where actually our world adopted computing and computers and databases and marketing and all this really cool software stuff, and then very quickly started standardizing. And today, if you look at hopefully I'm not insulting anybody here, but American Express is still actively hiring people who are fluent in COBOL, which is a pretty good sense for the sort of systems they're running in the back end. And so, IBM System 360, 370 probably. So what that means is these are very, very complex. They're also quite calcified. It's really hard to innovate when you have software systems that are built on very old stacks. And so my guess is the room, a lot of people here, and I count myself among them, are trying to bring what I would call a fully integrated stack of software that goes from issuing to accounting to payments to billing to servicing, to basically collapsing as many parties as possible. My guess is that in the established players as well as the new players, victories will really accrete the volume of loans, the transaction volume will really accrete to those that are willing to scrap a lot of the old systems and replace them with brand new systems. And I think that's going to be fundamentally the differentiating factor. More so, normally sort of when you sort of hang out with people in payments and credit especially, they'll tell you, what kind of a secret sauce do you guys use in underwriting? These repayment rates are so good. Fundamentally, risk management divided into fraud and credit. Fraud is where the innovation is. Credit underwriting in this country is fairly limited because of all the various consumer protections, and generally for very good reasons. So as a result, when you innovate on software in payments and credit, you're fundamentally innovating on process software. Process software can only be innovated on if you own majority of the stack. If you're trying to hire somebody to come in and configure your thesis installation or your Fiserv, it's going to be a while and it's never going to be fully yours. So my guess is that those that are squishing those disparate systems into a single system are ultimately going to reap the highest benefits.
So you mentioned this idea of, a lot of the laws that exist to protect consumers are there for a good reason, but not to challenge that per se. But if you think about extending credit to tens of millions of people that don't have it right now, if you were to make a loan to 100 people and you know that 50 of them aren't going to pay you back, the fair rate of interest would probably be 100% on the entire group. Or better yet, you can get rid of the 50 people that you know won't pay you back, and yet you have this catch-22 of credit. How do you have good credit? If you've taken a loan before and you've paid it back, that by definition means you kind of start on this on-ramp to getting good credit. So how do you think about banking this, literally tens of millions of people in this country that are underbanked, that don't have access to credit, while still dealing with kind of usury caps and all sorts of other regulatory constraints? And even if they aren't regulatory from the government, like if you're charging 100% interest, Google's not going to let you advertise. So there are kind of quasi-private regulatory bodies at work as well.
Yeah, so I think that's what they call a false choice. So fundamentally, what we're doing is we are comparing products and systems using APR. The rate of interest here in question is the APR, which isn't actually that old of an invention, but it is a profoundly wrong way of judging credit products. If you are borrowing money at a self-amortizing term loan with a fixed number of payments, the rate that you're paying on that loan matters a lot less, both to you as a consumer and as a comparison device, than the actual term. And like the actual dollars you'll pay is the thing to worry about. Many, many times when we're talking about payday lending, people say, oh my God, these people are awful, they're charging 1,500% interest. Yeah, that's sort of terrible, but the terrible thing is not that at all. The highest order bit in payday lending that really makes it such a toxic product is the fact that you're allowed to refinance your own loan. The fact that you can pay 1,500% APR for the entire year. Paying 1,500% APR over 2 weeks might actually be an acceptable value proposition. If you're really hard up for cash and 2 weeks later, you're gonna be just fine. So the notion of being able to lend money reasonably on reasonable terms for folks that are in a deep, deep subprime territory is actually, I think, harmed by this idea that high APR, low APR is the way of comparing these products. We need to come up with, and I realize that on the flip side, there's this notion of, if you try to explain, well, it's term and minimum payment and amortization schedule and capped interest versus uncapped interest, and revenue derived from fees. I mean, that's the proverbial 6-point manual that exists on the back of every credit card statement. So I don't think that's the way to go either, but reinventing a way to compare financial products that includes the notion of products that are not designed to keep you in permanent debt is probably the first step towards some sort of a sensible financial product that can be advertised on Google without neither undue attention to, hey, that's a high-rate product, nor the notion of this product is only good if your credit is already perfect. I mean, the classic adage in lending world is, I don't want to lend money to anybody who needs the money.
Right.
That's great, but there's between 10 and 50 million people in the US who need money, who could actually use it responsibly, and yet end up in payday lending and worse.
Yep. So last question, because we have about a minute left here, but it's a big one. So banks have the lowest cost of capital, and yet arguably the least operational efficiency, and half the people in this room, if not 90% of people in this room, are trying to take something away from banks right now. So we talked about, like, in 30 years, maybe credit card debt becomes an anachronism, or that term isn't around. Like, what is the role of the bank in 10, 15, 20 years? Like, what do they survive after the onslaught of the fintech guys?
So I think banking in the US is not at all a monolithic system. We actually live in this weird hybrid world of 5, 10 kind of a money center banks that are government captive utilities, and I think they survive because the government needs them to survive. That's sort of, we enact our monetary policy partially through that. There is a whole host of regional, super regional banks that I think are kind of up for the slaughter, to be honest, and I think that's what this room is engaging. And then there's a whole bunch of community banks that are there for historical reasons, and I'm not sure if DIC wants them to exist. And so I think the real sort of repartitioning, and I'm too much of an insider to sort of declare what's going to happen to regionals over regionals, but I think ultimately there will be another wave of consolidation. There will be, in a happy land or happy future, some kind of a marriage of super regionals or regionals with the most successful of fintechs. There'll be some blood because some of these banks are structurally, not regulator term structurally, but just structurally not long-term sustainable. Their cost of capital is not quite as low as the money center banks, and yet they're unable to, and you could argue that they're even less operationally efficient. So I think there's a lot of opportunity for every one of us who are trying to bring innovation to banking. But I think the flip side is you have to understand that ultimately, as you get larger, the number one asset a lot of these players have is charter, regulatory relationships, and understanding of much, much, much longer term financial history in this country. Even the last 50 years is sufficiently complex. So I suspect there is more to be gained by partnering than calling them out onto the carpet, but I think people each have their own strategies to set up.
All right, great. Well, thank you very much. Thank you, everyone.